This hearing will come to order. If everyone would take their seats, please. Good morning, and welcome to the first Ways and Means Committee hearing on elements of the tax reform discussion draft I released in February. The draft is focused on two primary goals: making the tax code simpler and fairer for families and employers, and strengthening the economy so there are more jobs and bigger paychecks for American families. As we explore what tax reform means to the American economy and for American families, we must move away from short-term tax policy and work toward greater certainty in the tax code. When I released the draft, the first item I asked for public feedback on was the extenders and our revenue baseline. The question is not only about the merits of the individual policy, but how we should treat the revenue gained or lost by either making those policy permanent, reforming them, or repealing them. Today's hearing will help the committee find answers to these questions. One thing everyone in this room can agree on is that today's tax code is too complex. And one of the best examples of the complexity of our current tax code is so-called tax extenders and their temporary status. As such, job creators are left constantly guessing if a group of policies are going to be around next year. Families and employers literally don't know what tax benefits they will be able to take advantage of from year to year. Yet when examining some of these provisions, such as the Research and Development Tax Credit, we find out that some have been around for 30 years or more. This is no way to write tax policy, let alone try to run an economy. The United States is the only country in the world that allows such important pieces of the tax code to expire on a regular basis. How can we expect businesses to plan on new hires or increased wages for workers when they don't know what their operating costs will be from year to year? Our draft extends or makes permanent 7 business tax provisions that expired at the end of 2013. These policies must still be evaluated in the context of pro-growth tax reform and how making those permanent will help grow the economy, simplify the tax code, and lower tax rates. Making some tax policies permanent now will open the door for the economic growth we need by giving consistency and stability to businesses small and large. Specifically today, we'll address the Research and Development Tax Credit, small business expensing, the active financing exception, depreciation for certain racehorses, CFC look-through, and 2 S corporation provisions. It's important to note that most of these provisions have had bipartisan support in the past. For example, prior to heading the committee, Sandy Levin and I sponsored the House bill to extend the Research and Experimentation Tax Credit. The witnesses we have before us today will help ignite an important discussion on the merits of these particular extender policies, specifically how they'll allow Americans to innovate, create jobs, and invest. By supporting permanent policies, Washington can promote certainty for American businesses and generate additional economic growth. But the committee's work will not end here. This is just the beginning of the conversation that we must have in order to overhaul the tax code so it's simpler and fairer for families. You've heard it from me before, and you'll continue to hear it. We can no longer accept the status quo. Washington needs to wake up to this reality and start offering concrete solutions and debating real policies that strengthen the economy and help hardworking taxpayers, and tax reform is one way we can do that. I look forward to hearing from our witnesses today and to working with members on both sides of the aisle on legislation we can move forward to address the provisions we discussed today. At this time, I'll recognize Mr. Levin for an opening statement.
Thank you, Mr. Chairman. Welcome, all of you. Today's hearing purports to discuss the benefits of permanent tax policy. I think we all agree that permanent tax policy provides certainty for all taxpayers, individuals and businesses, and is preferable to frequent short-term extensions. But what is missing from the agenda today is any discussion of how to pay for making tax extenders permanent. The Republican tax reform proposal that was unveiled 6 weeks ago set forth a business tax reform plan that made these and other temporary provisions permanent and did not add to the deficit in the first 10 years. In fact, that was pinpointed, even celebrated by some as a hallmark of the proposal. Yet the concept of fiscal responsibility has now been left behind, with today's hearing focused on making 7 of the roughly 60 so-called extenders permanent, as they were in the Republican tax reform draft, without discussing the provisions that would offset the cost of such action. We do not agree that adding more than $125 billion to the deficit to make these 7 expired tax provisions permanent or provide them with a long-term extension is fiscally responsible and should take priority over discussing the entire package of tax extenders. Fiscal responsibility cannot simply be a talking point that is set aside when it comes to providing tax incentives for the chosen few. We believe that tax policy, including the work on tax extenders, should be done on a bipartisan basis. If the Republicans were truly serious about providing certainty to taxpayers, the topic of this hearing would be a full discussion of the expired tax provisions and not just these 7 tax provisions selected by the Republicans to either make permanent or provide a long-term extension. Whether or not all of the provisions should be extended deserves a full hearing. Instead, the majority is moving ahead without any action on many important provisions, among them the new markets tax credit that encourages investment in economically distressed areas, the work opportunity tax credit that supports hiring certain groups of workers, the $250 deduction for teacher classroom expenses that is vital for schools, and the itemized deduction for state and local general sales tax claimed by millions of individual taxpayers, particularly in states without income taxes. Reforming our tax code so that it is fairer for working families, encourages investment in the U.S., and raises an adequate level of revenue in the near and long term is of vital importance. Whether the policies put forward in the discussion draft will meet those and other goals deserves a thorough public discussion far beyond what is on tap today.
Thank you. I would just note that in 2009 and 2011, there were many extenders that were passed by this Congress, and that none of them were offset. If we're going to continue to do that repeatedly, I think it's worth at least having this discussion. But thank you, Mr. Levin. But now it's my pleasure to welcome our panel of experts, all of whom bring a wealth of experience from a variety of perspectives. Their experience and insights will be very helpful as our committee considers the benefits of permanent tax policy for America's job creators. And first, I'd like to welcome Judith Zelisko, Vice President of Tax for the Brunswick Corporation, based in Lake Forest, Illinois. Second, we will hear from Bob Stallman, President of the American Farm Bureau Federation here in Washington, D.C. And third, we'll hear from James Redpath, Managing and Tax Partner with HLB Taugus, Redpath Limited in White Bear Lake, Minnesota. And fourth, we'll hear from Josh Odinitz, a partner at Baker & McKenzie, LLP in Washington, D.C. And finally, we'll hear from Thomas Hungerford, Senior Economist and Director of Tax and Budget Policy at the Economic Policy Institute in Washington, D.C. Again, thank you all for being with us here today. The committee has received each of your written statements, and they'll be made part of the formal hearing record. Each of you will be recognized for 5 minutes for your oral remarks. And we'll begin with you, Ms. Zelisko. You are recognized, and you have 5 minutes. Welcome.
Good morning. I'm Judy Zelisko, Vice President of Tax for Brunswick Corporation. I thank you for the opportunity to appear before the committee. Making products in the United States since 1845, Brunswick Corporation is now the world's largest maker of pleasure boats and recreational marine engines, as well as fitness and bowling and billiards equipment. And although we have been around for nearly 170 years and are one of the long-listed stocks on the New York Stock Exchange, you may know us better by some of the brands that we manufacture and sell, such as Sea Ray and Boston Whaler boats, Mercury and Mercruiser marine engines, Life Fitness exercise equipment, and Brunswick bowling and billiards equipment. We are headquartered in Lake Forest, Illinois, with offices and manufacturing facilities throughout the country, and indeed also in Asia, Canada, Europe, and Latin America. Brunswick ended the year with approximately 15,700 employees around the world, nearly 80% of which are employed in the U.S. During 2013-2014, it began or completed major expansions of several U.S. manufacturing and engineering facilities, including those in Florida, Indiana, Minnesota, and Wisconsin. We go toe-to-toe with some of the best competitors around the world, many quite larger than Brunswick. We had nearly $4 billion in sales in 2013, yet we compete with the likes of Japan's Yamaha, Suzuki, and Honda, Sweden's Volvo Penta, and Beneteau of France. We compete successfully by designing, developing, and introducing high-quality products to the marketplace, products that feature innovative technology and styling. We compete by developing and maintaining low-cost manufacturing processes. We do both effectively. We rely heavily on efficient and impactful research and development, the type of innovative work that is greatly enhanced by the R&D tax credit, which we urge you to reinstate and extend, and indeed make permanent. To fail to extend the R&D tax credit would be to remove one of the country's most effective tools to encourage investment by business, which counts for the lion's share of R&D done in the country. The R&D tax credit spurs U.S.-based innovation and R&D jobs. As an example, at Brunswick, we have concentrated the vast majority of our design and technological developments for our more than 14 boat brands sold around the world at Merritt Island, Florida. We have a staff of nearly 200 engineers there. Within the past 5 years alone, the Brunswick Boat Group has secured nearly 100 patents for a number of new and innovative products. One is called Quiet Ride, and it reduces over noise by 25 to 50%. Vibration was also greatly decreased, which means a more enjoyable and smoother ride. The R&D tax credit has been vital to our being able to maintain this drumbeat and jobs. We find similar examples at Brunswick's Mercury Marine Division, headquartered in Fond du Lac, Wisconsin, this year celebrating its 75th year in business. Research and development is a way of life at Mercury Marine, where we have approximately 400 engineers who have more than 700 patents granted since 1985. In 2012, Mercury Marine introduced the world's smallest, lightest, and most durable 150 horsepower four-stroke marine engine. Its popularity, along with a number of other new products, spurred Mercury to break ground last year for 2 expansion projects. Approximately 90% of the project work is being performed by Wisconsin companies. These are American jobs for work that is done in America for the benefit of an American company that has been in business since 1845. A permanent R&D tax credit provides both predictable cash flow to a company, which is important for a company's budgeting of its capital spending and research and development projects, and also prevents unnecessary fluctuations in the company's effective tax rate. Let me explain this latter point in a little bit more detail. When the company speaks to the investment community, the company forecasts an annual effective tax rate, which the analysts then plug into their discounted cash flow and earnings models. When the tax credit expires, as it did at the end of 2013, the company has to forecast its effective tax rate without the R&D credit, which increases the company's overall effective tax rate. If the credit is reinstated in the middle of the year and made effective at the beginning of the year, the cumulative to-date impact on the R&D credit on the company's effective tax rate becomes a discrete item in the company's financial statement in the quarter the law is effective. Generally, analysts ignore discrete items, so such items are considered unusual and non-recurring, resulting in the R&D tax credit's benefit on the company's annual effective tax rate being significantly reduced for a mid-year enactment. All this means that a permanent R&D tax credit provides certainty for the company in its annual budgeting and planning process and results in a more constant, less fluctuating effective tax rate. Thus, Brunswick shares the position of the R&D Credit Coalition and NEM that the tax code should include both a strengthened and permanent R&D tax credit and a current deduction for R&D expenses. We also support simplifying and strengthening the credit by increasing the alternative simplified credit to 20%. Therefore, we urge the committee and Congress to reinstate and extend the R&D tax credit for 2014 as early in the year as possible, and beyond 1 year to help bridge the gap to a permanent R&D tax credit. Thank you so much.
Well, thank you very much, Mrs. Lisko. Mr. Stallman, you're recognized.
Chairman Camp, Ranking Member Levin, members of the committee. My name is Bob Stallman, and I'm a cattle and rice producer from Columbus, Texas, and serve as the president of the American Farm Bureau Federation, representing farmers and ranchers from all across America. Thank you for the opportunity to speak today about the importance of Section 179 small business expensing and more broadly about the merits of a stable tax code. I also thank you for your leadership on tax reform. Until our tax code is rewritten in a simple and transparent way, it is appropriate to provide taxpayers certainty are reinstating important provisions that expired at the end of last year. While my oral statement is about Section 179 small business expensing, Farm Bureau also supports the extension of other expired provisions as outlined in my filed statement. Section 179 small business expensing allows a taxpayer to deduct all or part of the cost of new or used business property in the year of purchase, rather than depreciating the cost over multiple years. Qualifying property must be used in an active trade or business, and deduction and investment limits apply. Farming and ranching is a capital-intensive business. In order to remain competitive and profitable, farm equipment, buildings, and storage facilities must be continually upgraded and replaced. This allows agricultural producers to reduce maintenance costs, take advantage of labor-saving improvements, become more energy efficient, and adopt technology that is environmentally friendly. Smart business planning anticipates and budgets for such annual capital improvements. However, this proves challenging for farmers and ranchers because they operate on tight and unpredictable profit margins. The immediate expensing provided by Section 179 allows farmers and ranchers to cash flow purchases that otherwise might be delayed, or that would require them to take on more debt absent that provision. The pressure to buy capital goods at a predictable net cost is greater than ever. Newer equipment is both more energy efficient and often gentler on the environment. We all have an interest in seeing such improvements move from the showroom to farmers' fields. However, the volatile nature of farm profitability can make such investments challenging. Uncontrollable weather impacts crop yields, and unpredictable markets set the price of goods sold. These forces can create significant fluctuations in farm income and profitability. It is not uncommon for an agricultural producer to have a very profitable year followed by multiple years of negative income. When farmers and ranchers have good years, Section 179 small business expensing helps them to maximize available cash so that they can invest more for equipment replacement. This is why it is so important that the maximum deduction be maintained, a deduction of at least $500,000 with a phase-out threshold set at $2 million. A $500,000 limit is more modest than many might think. Just as the scale of modern farming is so much larger than it once was, so too is the machinery needed to run that farm. Farmers, for instance, can easily spend more than $200,000 for a tractor or $350,000 for a combine, plus another $100,000 for a header to go on that combine to cut the crop. And because of the sporadic profitability of most farms, investment is equally uneven. A farmer might well bunch several years of normal investment into 1 year if conditions warrant and sufficient cash is available. This averages out against the poor years when cash flow is not available to invest. This reality allows farmers to make their businesses more efficient and sustainable for the long term if the necessary tax policies are in place. Farmers' upgrades and improvements made using Section 179 deductions help to provide some input cost certainty during periods of unpredictable profitability. In conclusion, Section 179 small business expensing provides many benefits to small businesses, including farming and ranching. Those benefits are erased when the deduction lapses, even for short periods of time. Even as we meet here today, farmers and ranchers are holding off decisions to make capital investments given the uncertainty about renewing the expensing provisions of Section 179 that were available in 2013. There is not a lot of incentive to make these purchases at the maximum amount of $25,000 that can be expensed under current law. Farm Bureau believes that Congress should end its practice of extending important tax provisions for just 1 or 2 years at a time. Farm and ranch business planning, which is already difficult, becomes nearly impossible with an ever-changing tax code. Tax uncertainty means farmers cannot truly make long-term plans as long as the continuation of this provision and others remains in question. For all these reasons, Farm Bureau supports a permanent Section 179 small business deduction with a maximum deduction of at least $500,000, reduced dollar for dollar when investments exceed $2 million. Thank you for allowing us to present our views. I'd be glad to take questions later from the committee.
Thank you, Mr. Stallman. Mr. Redpath, you're recognized for 5 minutes.
Chairman Camp, Ranking Member 11, and other members of the committee, thank you for the opportunity to testify today. My name is Jim Redpath. I am the managing partner and a tax partner at HLB Todges Redpath, a 125-person accounting firm serving clients in the Midwest. I've been a tax accountant for over 30 years, working primarily with closely held businesses, many of which are S corporations. Let me begin by thanking the committee, and in particular the chairman, for his hard work to improve the tax code. At our firm, we help hundreds of closely held businesses make better decisions that create value and jobs. Those efforts are hindered by a tax code that is simply too complex. The rules governing S corporations are a good example. The S corporation promotes private business, capital investment, and increased employment, but they are subject to various restrictions that adversely impact ownership, capital, and growth. The chairman's discussion draft helps mitigate some of these restrictions. I'll start with the built-in gains provision. In 1986, the Tax Reform Act repealed the General Utilities Doctrine and the related Section 337. These policies allowed C corporations to sell their assets and liquidate the business while paying a single level of tax. The repeal meant that for the first time there would be double tax on the sale of corporate assets followed by a liquidation. The Tax Reform Act was a wonderful piece of bipartisan legislation, but this repeal wasn't. The House version included a 2-year rule designed to prevent avoidance of this new double tax. The Senate version had no repeal at all. One would expect negotiations to result in an anti-avoidance rule somewhere between 0 and 2 years. However, the final bill enacted the built-in gains tax with a 10-year anti-avoidance rule. This is referred to as the big tax. The purpose of the final rule is similar to the House provision, to prevent a C corporation from converting to an S corporation when a sale was imminent just to avoid the double tax. The impact went well beyond that purpose. Today, if an S corporation sells certain property or collects certain types of income before the end of the recognition period, the combined tax can be as high as 60%. No company willingly triggers the big tax. I find big tax causes many S corporations to hold unproductive assets. For example, I work with a road contractor who's sitting on old equipment out in the boneyard rusting away that could be sold to raise capital for expanding the business and hiring more people. That investment potential is being stymied by the big tax. Other clients would like to sell their businesses to up-and-coming entrepreneurs or employee groups, but can't because of the prohibitive tax. The IRS says tens of thousands of corporations convert to S corporations each year. The big tax effectively locks up for a decade some of the capital of these companies, limiting new investments and the creation of jobs. Congress recognized that a 10-year recognition period is too long and has voted to reduce it 3 separate times, but each time this reduction has been temporary. A temporary extension forces many businesses into a difficult position. Should they sell assets or the business prematurely to take advantage of a temporary window, or hold off and hope Congress extends it again? Making the 5-year recognition period permanent is good tax policy and would provide S corporations stability and certainty so they can make business decisions that are best for the company, its owners, and stakeholders. The other S corporation extender made permanent by the chairman's discussion draft has to do with charitable contributions. For most taxpayers, gifts of appreciated property produce a deduction equal to the property's fair market value. S corporations who donate appreciated property will incur a future tax liability because of the way the current rules work. This unintended result was remedied as part of the 2006 Pension Reform Act. This provision was temporary, and while Congress has extended it numerous times, it expired again at the end of 2013. Making this provision permanent would help ensure that S corporations owners fully benefit from the value of their donations to charities. Beyond these 2 extenders, there exists a significant opportunity for improving the S corporation rules to ensure that S corporations can compete with other entity types. The provisions are part of the bipartisan S Corporation Modernization Act, sponsored by Representatives Reichert and Representative Kind. I am pleased that the chairman's tax reform discussion draft makes permanent several of these reforms. Mr. Chairman, let me close by saying that making permanent the 5-year built-in gains recognition period preserves the original intent of the 1986 Tax Reform Act and is critical to helping corporations deploy locked-up resources. I appreciate the chairman and the committee for considering this provision, along with all other S corporation reforms, and I look forward to your questions.
Thank you, Mr. Redpath. And Mr. Odens, you're recognized for 5 minutes.
Thank you. Chairman Camp, Ranking Member Levin, and members of the committee, it is an honor to appear before you today to discuss the very important topic of two expired tax provisions, the active financing exceptions to Subpart F and Section 954C6 of the Internal Revenue Code, also known as CFC look-through. I applaud the committee for making significant progress on tax reform, and I urge the committee to make these two provisions permanent as part of tax reform or outside of tax reform. I also appreciate that this committee is willing to receive testimony from a former Senate Finance Committee staffer. I am a partner in the Washington office of Baker & McKenzie. However, I appear today on my own behalf, and my testimony does not necessarily reflect the views of my firm or our clients. Generally, the active income of a U.S.-owned controlled foreign corporation, or CFC, is not subject to U.S. income tax until distributed to U.S. shareholders. Under Subpart F, certain categories of income are treated as passive income and are subject to current U.S. income tax, including dividends, interest, royalties, and rents. Income from the active conduct of a banking, financing, or other similar business was exempted from Subpart F until 1986. These exceptions were restored on a temporary basis in 1997. The active financing exceptions to Subpart F, or AFE, currently exempts, or when they come back into effect, currently exempt certain income from treatment as passive income if a CFC satisfies an entity-level test and a qualifying income test. The mechanics of these rules are addressed in my written testimony. These rules are designed to reflect sound tax policies. First, banks, financing, and other similar businesses earn income that looks like passive income but is derived from an active business. AFE appropriately treats such income as active income and ensures that such financial service businesses are treated the same as other businesses, such as manufacturers and service providers. The entity and income rules ensure that only banking, financing, insurance, or other similar businesses receive such treatment. Financial service companies compete across the globe. AFE allows U.S.-based businesses to be treated like their foreign competitors. Such competition also creates U.S. headquarter jobs that support those foreign operations. Many U.S.-based manufacturers establish financing subsidiaries that provide financing for goods sold from the United States. AFE allows U.S.-based manufacturers to offer competitive financing on U.S. exports, and this is a good policy. CFC look-through provides an exception to Subpart F as well. The provision generally provides that dividends, interest, rents, and royalties received or accrued by one CFC from a related CFC are not treated as passive income, so long as the payments are made out of active foreign income. The legislative history from 2006 states that Congress enacted this provision to remove impediments to business decision-making and allow U.S.-based multinational corporations to deploy capital as and where needed without imposing U.S. tax. Congress recognized that businesses are truly global and will need to deploy active foreign income to expand foreign operations and compete with foreign-based multinational corporations. These rules help U.S. businesses to fund operations in locations with the greatest potential for growth, as opposed to resorting to loans from third parties. Permanence is fundamentally important for all Internal Revenue Code provisions because virtually every corporate decision is taken after a careful review of the after-tax return on investment. If the after-tax return on investment is uncertain, business decisions are either delayed or not taken. An Internal Revenue Code run by temporary tax provisions impedes legitimate business decisions and forces behavior that does not make good business sense. Continuing a Band-Aid approach to these provisions undermines the congressional justification for them. Permanence is essential for U.S.-based financial service sector businesses. A permanent AFE would eliminate great uncertainty regarding future tax liability. It would also allow financial service companies to appropriately price their products and services in foreign markets. Permanence takes on added importance with respect to CFC look-through. Without look-through, taxpayers incur costs that do not advance anyone's business or make any company more competitive in the marketplace. Permanence would eliminate these wasted expenses and would allow taxpayers to effectively deploy cash where needed, recognizing that Subpart F's entity-by-entity rules are antiquated. Thank you. I would be happy to answer any questions that you may have.
Well, thank you, Mr. Odens. Mr. Hungerford, you're recognized for 5 minutes.
Thank you for inviting me to share my views on the business tax extenders. Each year, dozens of temporary tax provisions expire, and many are regularly extended for another year or two with little or no scrutiny. I applaud the efforts of this committee to scrutinize the tax extenders. Let me summarize my main points. First, the tax extenders package is being considered in a challenging fiscal environment of budget deficits as far as the eye can see, in which maintaining long-term fiscal discipline is necessary. Second, making some or all of the expiring tax provisions permanent without offsetting the revenue losses will permanently increase budget deficits and accelerate the accumulation of federal debt. Third, running large annual budget deficits when the economy is operating at or near its potential can accelerate inflation, increase interest rates, reduce private sector investment, and reduce economic growth, thus destroying jobs. It is likely that any jobs created by these 7 tax provisions would be entirely offset by jobs lost due to larger budget deficits over the longer term. In the time remaining, let me expand on these points. After 2023, we face the unsustainable growth of federal debt as projected under CBO's extended baseline, a baseline that assumes these 7 tax provisions, as well as 50 to 60 other expired provisions, are not extended. Between now and 2023, federal debt rises from 72% of GDP to 78%. Barring tax and spending changes, federal debt as a percentage of GDP is projected to grow to over 100% by 2038 and to an unprecedented 200% by 2080. Concern over our long-term fiscal challenges appear to have made long-term fiscal discipline a priority. Chairman Camp recently unveiled a comprehensive tax reform plan that is revenue neutral over the 10-year budget window. Revenue losses from tax rate reductions and making certain tax provisions permanent, including most of the provisions under discussion today, are offset with revenue increases from base broadening. The advisory for this hearing, however, notes that revenue neutrality is not consistent with recent practice by Congress in its consideration of tax extenders legislation. I am left to wonder if the commitment to long-term fiscal discipline is being abandoned for this extenders package. So let me examine the budget implications of the 7 provisions under discussion today, which account for almost half of the revenue loss of all expiring tax provisions. Making these 7 tax provisions permanent with no offsetting revenue increases would add over $200 billion each year to the deficit, thus adding over $200 billion to federal debt by the end of 2023, almost 1 percentage point of GDP. Even a 2-year extension, as proposed by the Senate Finance Committee, would add almost $50 billion to federal debt by 2023. And modifying some of these provisions, as Chairman Camp has proposed, can reduce the revenue losses somewhat, but the overall consequences are similar, a large increase in projected federal debt. If long-term fiscal discipline is abandoned, then we face a future of budget deficits that are larger than expected. Research suggests that running large annual budget deficits in perpetuity can have adverse economic consequences, thus destroying jobs. And as I mentioned before, any jobs created by these provisions would likely be entirely offset by jobs lost due to larger budget deficits over the longer term. Given the long-term fiscal challenge we face, I believe that whatever is decided about these provisions, the decision should not increase projected budget deficits. The tax extenders should be paid for by increasing tax revenues. Thank you. I would be happy to answer any questions you may have.
Well, thank you. Thank you all for being here, and thank you for your statements. I have a question. Every time Congress has considered a short-term extenders package, the Joint Committee on Taxation, which is our referee in these matters, estimates that the provisions will actually cease to exist. So they look at the costs and say these provisions aren't going to be continuing. However, with spending programs on the appropriations side, those are always assumed to go on forever. And even if they expire, they assume they're going to go on forever. And so the Congressional Budget Office estimates that further extensions of spending have no cost. But yet, with tax policy, the estimates say that further extensions of current policy do have a cost. So there's a difference of treatment in terms of tax relief and spending, which creates a bias, in my view, about a bias against extending expiring tax programs in favor of extending expiring spending programs. But if you look back at history, Congress virtually never pays for extenders, including those like the R&D tax credit, which have supposedly been temporary since 1981. So my question is this: given the repeated extensions, and isn't treating long-standing features of the tax code as if they were permanent is certainly a fundamentally more honest way, an accurate way, frankly, and a more transparent way of looking at the costs and benefits of these policies? And Mr. Odens, I just ask for your opinion on that.
Looking at it from the business perspective, businesses cannot rely on provisions when they analyze whether to move cash from one location to another or to engage in a transaction. So they can only rely on current law and cannot rely on law that may or may not be extended. As you've noted, the R&D credit has been extended since 1981. There's an exception, though, where it expired, and so taxpayers could not enjoy the credit during that period of expiration. So I look at these issues from a business perspective, and it's difficult for businesses to make decisions without permanence, or at least to understand how long these provisions will be in effect.
Right. Mr. Redpath?
I've started my career in 1981 and have dealt with these extender provisions for years. And it makes businesses do things they wouldn't otherwise do. We have a temporary window of opportunity, and it makes us make tax-motivated decisions versus business decisions that may not have been made had we not had to deal with the expiration of the tax provisions.
Again, Mr. Stallman.
Farmers and ranchers deal with extensive uncertainty. It would be preferable to have more certainty with respect to the tax code. As has been referenced by my colleagues, farmers are making these decisions based on what they know. And right now, without clear certainty about what the future of some of the extender provisions, particularly the Section 179 expensing provision, that's hindering, or at least slowing down their decisions to make these expenditures and investment, which are important for maintaining an agricultural productive base, and frankly important for the manufacturers and all the jobs created by those who create this equipment.
All right, thank you. Mrs. Lisco.
Having a permanent R&D tax credit, which I was focused on this morning, really helps business to be able to predict its cash flow. And in the planning process, when you're looking at R&D projects that could span 4 to 5 years, having that certainty is critical in determining what that cash flow is, whether it's there or not. If relying on a credit that's basically has an extension of 1 or 2 years or might not even be there, obviously is not part of that process, because it can't be. You need to have predictability. You need to have certainty. So with regard to cash flow, which is important in determining the amount of funds that you're going to be able to set aside for those research projects, it's important to be able to know that the R&D credit would be around for business. In addition, there's also financial implications I mentioned in my written statement and in my oral testimony with regard to how the investment community looks at a publicly traded company. When you're looking at whether or not an R&D credit is available, that impacts your effective tax rate. Why is that important? Analysts take that effective tax rate and factor it into their financial models. Why is that important? Well, it's the analysts who determine what they're looking to forecast your earnings per share. Your earnings per share are on an after-tax basis. They take that earnings per share, then use a multiplier which they attribute to your particular company, depending upon the industry and what its history of earnings have been, and then they come up with basically a share price and a range, which then they use for their buy-side and sell-side analysts with regard to your stock price. So again, Predictability is so critical in this area, and permanent tax policy would enable that to occur.
We've had dozens of hearings over the last 4 years in this committee where we've heard from many witnesses who said that investing in their businesses and effectively planning for the future requires certainty. And I heard all of you mention that as well, and especially when it comes to tax policy. You mentioned, each of you, how some of these temporary tax provisions affect your companies and clients and some of your members. But what is your sense in terms of the economic benefit if businesses could generally rely on tax rules which would or would not be permanent going forward? I mean, what do you think sort of the overall economic impact might be if you can? Ms. Zalisko, I'll start with you and go the other way.
Thank you. Certainly investing and having certainty with regard to the R&D credit, I think, has a tremendous multiplier effect from an economic standpoint. When you basically are able to invest and create new products, which, again, are accepted in the marketplace, you're providing not only jobs in developing those products, you're providing sales revenue. Therefore, you're able to further invest in your company, and that means jobs. Jobs mean housing. Housing means there are correlative businesses in a particular community that are going to thrive. So therefore, I think definitely the multiplier effect is often missed, I think, when you're looking at permanent tax policy and the certainty that it provides.
All right, Mr. Stallman.
Well, agriculture is very similar. You have to maintain your productive base. You have to make capital investments to do that. Having certainty about tax policy allows that planning to occur. Without that, you're sort of delayed and behind the curve, if you will, from deciding how and when to make these investments. That erodes your productive base. You know, our agricultural export surpluses are certainly contributing to our balance of payments, the jobs that are created through that activity, as well as the internal production and the amount of products and inputs that we purchase from suppliers. All of that creates great economic activity. With tax certainty, you have more of that. With tax uncertainty, you have less of that.
All right, Mr. Redpath.
Let me answer that with an example. I was working with a client last year, and in 2012, their 5-year S-Corp built-in gains recognition period expired. And so they had an opportunity in 2013 to take advantage of the temporary rule of 5 years. And they owned millions of dollars of pipe in western Minnesota that was subject to the built-in gains tax that they would need to sell in 2013 in order to benefit with regards to the current temporary 5-year rule. This is the kind of pipe that you can't sell in a year. So it really impacted their decision. What do they do with this pipe? Do they sell it for less than they should sell it for? Can they make a business decision? Can they hope that you extend it to 2014 and beyond? What they ultimately had to do is sell some of this pipe for less than the real value of the pipe in order to move it to take advantage of the temporary window with regards to the 5-year recognition period on built-in gains.
Thank you. Mr. Odens.
Sure, I'd like to also provide an example. So U.S. manufacturers frequently establish a foreign subsidiary for financing their products. And as you may know, in a banking or similar business, the margins can be pretty low. Interest rates on loans take into account after-tax returns on that product. And so for a U.S. manufacturer, it's important to have an interest rate that is competitive in the marketplace. And if the U.S. manufacturer cannot rely on the pricing of that interest rate as being competitive, then they may not get the financing for their widget and may lose on a sale of their widget, and a foreign manufacturer may get the transaction. So I can't tell you the macro effects, but on a business-by-business effect, these rules have significant impact.
All right, thank you. Mr. Levin.
Thank you very much, and welcome again. Let me just kind of go down the line, if I might. We'll start with you again, Ms. Lisisko. As Chairman Camp mentioned, I very much favor the extension of the R&D tax credit. We've been working on this. I'd like to ask you, do you know what according to joint tax, the cost would be of permanent extension?
I don't have that number currently available. I know it's significant, But again, I think from a tax policy standpoint, it's important. The country, back in 1981, when it put this credit in place, really led the world as far as being ahead of the curve and realizing the importance of providing incentives for businesses to invest in research and development.
I agree. I mean, I've been one of the most active proponents, but I just wanted to ask you about the cost. So, Mr. Stolman, on the small business expensing, do you know what the joint tax 10-year estimate is for making it permanent?
I'll have to concur with my colleague. I do not know that specific number, but once again, in terms of tax and economic policy, the provision itself is very important, I believe, in generating additional economic activity and thus, generating extra revenue in terms of tax revenues.
Okay, so for R&D, their estimate is $76 billion. For expensing, it's $69 billion. So, Mr. Redpath, you come off more easily. Do you know what the estimate is for your provision?
I'm sorry, no, I do not, but I work closely with many S corporations that have potential built-in gain tax exposure. And as I said in my oral testimony, no one willingly pays the big tax. They structure transactions, structure operations in any way they can to avoid it, which ultimately ends up tying up assets for 10 years or more.
No, and so you've stated the merits, and I think there's much to be said for each of your testimony. I just wondered about the cost. Mr. Odens, I'm going to ask you, you mentioned two of them, the CFC and also active financing, and we've been working on these two issues forever. I remember working with Mr. Houghton on the active financing. Do you know what joint tax projects as the cost, the 10-year cost of making this permanent?
Sure. I believe that for CFC look-through, the cost is around $10 billion over the 10-year window. And then for AFE, I believe the cost is in excess of $50 billion over the 10-year window, but under $100 billion.
According to joint tax, their estimate for 10 years for the CFC provision is $20 billion plus, and for active financing is $70 billion. You're pretty close, though 10, 20 billion is a lot of money. So I just want to mention that because, as I said in my opening statement, I think we need to look at these issues in a holistic way, and not only these specific ones, but others that are not being looked at. And I think the issue of cost, no matter how you try to shape it, is indeed relevant. I yield back.
Mr. Johnson.
Thank you, Mr. Chairman. You know, I didn't get a chance to tell you, but I want to take this moment to thank you for your service, in particular, your tireless effort in advancing the cause of tax reform.
Well, thank you.
Ms. Zalisko, I have a number of questions I'd like to ask you about the R&D tax credit. First, to begin with, we have heard that the potential for long, drawn-out fights with the IRS over the R&D tax credit can discourage companies from even claiming the credit. Has Brunswick faced similar fights with the IRS?
We've had some disagreements with regard to the R&D tax credit with the IRS. Basically, one of the challenges that we face is that oftentimes the IRS wants to basically thinks that you should keep your books and records such that they're on a project-by-project basis with regard to these R&D projects, as opposed to we keep our books and records on a cost center basis. And so the IRS wants to directly be able to point to the different costs involved in the R&D effort to a particular project, as opposed to taking a more reasonable approach in an allocation that would be supportable but would make more sense. So oftentimes that's where we faced our challenges.
So you're saying the IRS isn't reasonable. I have to agree with you. Do you have any more thoughts on how to make the credit more taxpayer friendly?
Well, I think if we basically looking at the alternative simplified credit, where you basically would eliminate some of the controversy that taxpayers have been challenged with regard to the base period receipts calculation. You're talking about a base period that goes back to 1984 to 1988, where you're looking at data that's 25 to 30 years old. So, and if you're in a company that has bought businesses and sold businesses where you've had that research and development in those years, you have to adjust for that. Needless to say, that probably makes it at best problematic in trying to track that. So I think when you're going to an alternative simplified credit, you're looking at data that's 2 to 4 years old, a lot more manageable than 30 years old.
Well, as you may know, in Chairman Camp's tax reform discussion draft, the R&D credit's modified, so it's based on the alternative simplified credit, ASC, rather than the traditional credit. Do you have any thoughts on how shifting to the ASC would improve the R&D credit?
Well, as I said, I think basically that would eliminate the controversies around the base period by going to an alternative simplified credit. I would urge the committee and Congress to think about in the alternative simplified credit, however, to not eliminate supplies, the deduction for supplies and software, because for our company, supplies can be anywhere from 20 to 25% of our total qualified research expenditures. When we're making a new engine, you basically destroy a lot of prototypes in that process when you're getting it right. So I would urge the chairman and the committee to rethink about the supply issue with regard to the deductibility.
Well, you think changes like that would make it easier for companies to claim the credit generally?
I think we have found when the IRS actually goes out and visits your facility and they talk to the engineers that are basically involved in the process, that they truly realize that what R&D is all about, as opposed to sitting back in a field office in a vacuum.
You think some of them do that, huh? Thank you so much. Thank you, Mr. Chairman.
Thank you. Mr. Doggett.
Thank you very much, Mr. Chairman. Despite all of the talk about tax reform that will be more simple and equitable, and tax reform that won't dig us deeper into debt, Republicans have chosen to first not introduce that legislation. They've had reserve since January of last year, H.R. 1, for comprehensive tax reform. And as of today, it still shows H.R. 1 is reserved for the Speaker. Instead, today's hearing is about borrowing more money from the Chinese to maintain some very complex corporate tax code provisions that depend upon their very complexity to work. The controlled foreign corporation provision and the active financing provision are all about this Congress picking winners and losers rather than leaving the marketplace to decide. They lower the effective corporate tax rate for some businesses and say to some businesses that they don't have to pay as much for the cost of our national security and other vital services as their neighboring corporation that is competing and paying a higher effective tax rate. Mr. Hungerford, I want to ask first about the active financing provision. We understand that that would take borrowing about $70 billion of additional debt over the next 10 years to maintain. Under existing law, if a financial institution makes a loan to a domestic corporation, to one of Mr. Stallman's farmers, to a company that's making it in America, manufacturing here, as I understand it, it reflects in its corporate tax return the interest that it earns from extending the loan, and it deducts whatever the cost of extending that credit might be, and it pays taxes on the difference. Is that right?
That is correct, and thank you for asking a
But
question of me.
if it is a loan or some other form of credit to a company that's not making it in America, that is a foreign operation, then it can take its expenses now for extending the credit, and it can take its profit on its earnings whenever it feels like it. Isn't that essentially what the active financing provision allows?
The active financing exception is an exemption to Subpart F, and if this income was all considered Subpart F, it would not be, it would be taxed immediately.
Yes, and the very fact that we're talking about Subpart F and the exception to Subpart F and active financing and whether it's active or passing or is the kind of thing that does add complexity and causes the eyes of most people to glaze over rather than to look at the effect of what the provision is, which is to provide, is it not, Mr. Hungerford, a substantial subsidy to encourage the export of American capital and American jobs rather than to invest in making it in America.
Yes, that is correct.
And as far as the controlled foreign corporation provision, the CFC look-through exception is concerned, another $10 billion that we would borrow from the Chinese. If you have two companies right next door to each other, and one of them can afford a bunch of fancy accountants and consultants and high-priced lawyers to rig up some corporate fiction that they've got a subsidy in the Bahamas or Bermuda, they can license their their patents, their copyrights, perhaps their trademark name to a tax haven company and strip off earnings that they've had right here in America that their smaller neighbor doesn't do. And the effect of that is to lower their operation, their profits by increasing their costs in some tax haven. Isn't that the way it works?
Yeah.
And in fact, under using both of these devices and many other complex provisions, over the last decade, I believe GE has not only lived better electrically, but they've managed to pay an effective corporate tax rate of less than 2%, 2 cents on the dollar, which is a deal that any hardworking American or business would love to have.
That's correct.
They've essentially repealed their taxes, except at a certain minimal level. And under these controlled foreign corporations, you actually end up with what many people have called stateless income. How does that work? And how does some income just never get taxed by any entity, either here in America to contribute to the cost of our national defense or by anyone else?
Well, I mean, part of it is through the CFC look-through rule that income can be shifted, that is, from a high-tax country, high-tax foreign country to a low-tax foreign country in such a way that it's not taxed in that high-tax foreign country, and the transaction is not taxed by the United States. So essentially,
all right. Time has expired.
Thank you, Mr. Chairman. Thank you.
Mr. Brady's recognized.
Chairman Camp, thanks for your leadership tireless leadership to fix this broken tax code and rein in the IRS, get this economy going. This hearing's about jobs, and we need them so badly. This is the worst economic recovery in 50 years. Millions of people have given up looking for work. Millions more can't find them. It's taken 6 years just to break even on the number of jobs along Main Street. And today, proportionally, fewer Americans are working today than when this recession ended. We're actually going backwards in part of this economy. So, and those who are being hurt most are women and young people and those just graduating from college. So we ought to be focusing on jobs. What I hear from our witnesses today is that these tax provisions are critical to creating jobs, and they are less pro-growth if they're temporary, and far more pro-growth if they are permanent. And businesses can count, of all sizes, can count on them, from innovative businesses and doing research and development, investing in America with those jobs, our small businesses and family farms and ranchers creating jobs here in America. About the CFC look-through that allows American companies to be competitive against China and Europe and Latin America so we can create jobs here in America. This is what this hearing is all about. And while I appreciate the concern about fiscal responsibility, what Chairman Camp has shown in his discussion draft is that you can lower rates. You can make this tax code more pro-growth without adding a dime to the deficit. So this really is about removing an asterisk around these temporary provisions in the code so we can grow the economy more. Chairman Johnson has asked about the research and development area, which I have an interest in as our members do. I want to talk about small business expensing, because right now one of the missing ingredients in this recovery, one of the reasons it's so weak, is that businesses aren't able and don't feel comfortable and certain to reinvest back in new equipment and software and technology. I wanted to ask first Mr. Stallman and then Mr. Redpath how important it is for, and we need big businesses to invest, we need small businesses to invest. So I want to ask both of you gentlemen, how important is it that our businesses be able to expense, that $500,000 figure, and how important is it that it's made permanent so they have that certainty? How important to the economy is it? Mr. Stallman?
Well, from a farming and ranching standpoint, we believe it to be very important. I referenced the high cost of equipment that exists. I didn't mention the cotton pickers that are $600,000 to $750,000 at a pop now. So the point is we need the $500,000 expensing. Now, this isn't about tax avoidance. This is just changing when you pay the tax, because you're just accelerating the expense for that year. It helps provide additional cash flow. It helps you make that decision, and having certainty about that is what allows you to move forward. And just a personal example, I'm right now thinking about having to replace a tractor on my farm. Well, I'm going to wait and see what happens with these tax extenders and what happens to the provision for Section 179 expensing before I make that decision.
And when you buy that tractor or that cotton picker, it certainly reverberates through the economy, doesn't it?
Absolutely, all the way from the raw material suppliers to the manufacturers to the dealers selling it to the people that service it, just all the way down the line.
Thank you. Mr. Redpath?
Thank you. Two things. One is answering your question also answers the question of why we should extend the built-in gains tax period, because that will free up the capital necessary to make those expensing acquisitions. Yeah. And I look at the expensing provision as a provision that absolutely works. And the reason it works is everyone who qualifies for it uses it. It's one of these provisions that is in the code. If they qualify, they use it, so it must work. And for my clients, spending those investments is how their companies grow. And when their companies grow, they create more jobs.
Okay. Well, Mr. Chairman, thank you for hosting this here. I know we have members wanting to inquire about a number of the other provisions, but thank you for holding it.
Thank you. Mr. Lewis.
Thank you very much, Mr. Chairman, and thank you, Mr. Chairman, for holding this hearing. Mr. Hunsford, in your testimony, you raised the importance of focus on long-term discipline. You also highlight the question of the objective of a tax break. When considering tax extender and tax reform, what action by this committee will cause the least economic disruption?
Well, I think, two things the committee could be doing is, one is determining which tax codes belong in the, or which provisions belong in the tax code and which do not. And I think there is a lot to be said from both a business standpoint and a budgeting standpoint to make them permanent.
Furthermore, in your work, do you believe that a broad or narrow lens should be applied when considering tax policy, and why?
Well, I think as broad a lens as possible. You need to take into account other things in the tax code. Also, you need to take into account the whole budget situation, basically spending and the revenue side. I am concerned over the long term about deficits and unsustainable accumulation of debt.
Well, thank you very much. Thank other members of the panel for being here. I yield back, Mr. Chairman.
Thank you. Mr. Teaberry.
Thank you, Mr. Chairman. Mr. Stallman, welcome. I understand you hail from Columbus, Texas. I hail from Columbus, Ohio. Good to have two Columbus guys in the room. Mr. Brady posed a question regarding Section 179, and you gave your tractor example. If you could just go a little bit further on what ranchers and farmers have done in reaction to what was the law at the 500,000 expensing level. We know what they haven't done because of the new amount of 25,000, and what you believe would happen if we extended permanent law to the old limit of $500,000 in Section 179?
I'll tell you this anecdotally, based on my conversations with farmers. There were a number of them that accelerated their purchase decisions prior to December 31st because they had certainty up to that point. They were uncertain about what was going to happen after that. Right now, I would suggest that there are a number of them that are in a holding pattern, waiting to see what happens before they commit the funds to purchase equipment in excess of what the current $25,000 deduction would allow. And if it were made permanent, that would create the certainty, I believe, for farmers and ranchers to do that very necessary planning for their capital structures or capital improvements that they need to maintain a productive farm and ranch. I think it would unleash dollars that frankly have been held, given the fact that we have had a good agricultural economy. Now that's subject to change, obviously, but we have had a good economy where farmers and ranchers have had some profits and some cash, and they're waiting to see what they're going to do with that.
I've heard the same thing anecdotally from small business owners in my district in Central Ohio, and plan on introducing a bill that would extend this permanently, a bipartisan bill later this week. And I know your organization is supportive of that, as are many other small businesses. So thank you for being up here today from Columbus, Texas. Mr. Odence, on another matter that Mr. Doggett brought up, reading your testimony, I think you have a bit of a different view on the active financing exception. Can you talk about the process that you and your clients go through because of the temporary nature of this provision in the past, and how this is much like 179, a provision that actually helps American competitiveness, a little bit different than what we heard a little bit ago?
Sure. I think it's important to note that AFE does not export jobs. What it does allow is for a bank or similar business to establish a branch or to establish operations in a location. And if you think about it, when people go to a bank, they like to walk into a physical bank. And so it's important that U.S. headquartered banks can establish a local operation that facilitates a relationship with clients. And if the AFE rules do not provide or don't exist, then it's difficult for clients to price out loans, certificates of deposit, and other like instruments at a competitive rate with foreign-based multinationals that have operations, real physical operations in the same jurisdiction. And as far as jobs, a lot of companies manage, U.S.-based multinationals manage their foreign currency risk and other international risks in their headquarter location, and so that happens in the United States. So there's a knock-on effect of jobs when a U.S.-based bank opens operations abroad and is then able to manage its risk domestically.
And this, correct me if I'm wrong, this allows U.S. financial services companies that do business all over the world to be competitive with their foreign competitors, and treats them exactly like non-financial services companies are already being treated under the law.
That's correct. AFE merely treats a bank or other financial service provider like a manufacturer. It doesn't provide a better position vis-a-vis Subpart F. It just treats them equally like non-financial service providers.
And it does not allow for any deferral of profits in the U.S.
That's correct.
So why do you think it gets attacked?
I think the discussion is it sounds like a greater discussion of whether we should have deferral, which is, that is a different discussion, but to the extent we're going to retain a system that has deferral, I don't see a reason to distinguish between banks that engage in active business versus a manufacturer that makes widgets.
My time has expired. Thank you so much.
Thank you. Mr. Kind.
Thank you, Mr. Chairman, and thank you for holding this hearing, and we appreciate the witness's testimony here today. Let me just start with a general question for the panel. Other than Mr. Hungerford, who testified pretty clearly that he thought that moving a extension of these expired provisions without paying for them may be detrimental to economic growth in the future, does anyone else on the panel have any concerns about the potential lack of offsets to pay for these expired provisions as we move forward? Not really? Well, one of the hardest things that we have to do around here, whether it's new program spending or whatever, is finding offsets in order to pay for things so that we're not adding to the deficit, especially in future years, the out years, as they say. So I think that's going to be an issue we're going to have an ongoing conversation about with the extension of this. Mr. Stallman, appreciate your testimony on the importance of 179 expensing. Obviously, I come from a large agricultural area in the state of Wisconsin. I've been working with Mr. Teaberry and introducing some legislation along those lines, a permanent extension of 179, indexing it for inflation. What we're thinking about doing, though, is taking the 500,000 and lowering it to 250 for real property, but still indexing it. Would you have any concerns with that, as it would affect real property?
Are you talking about the single-purpose buildings?
Yes.
Basically? 500 would be better, obviously, because, you know, these buildings, particularly with the technology and the systems that are put in place now, are getting more expensive, not less expensive. And I think that's the issue there in terms of the growth and cost of these kind of single-purpose buildings.
Yeah. I don't know if you've had or someone at Farm Bureau's had a chance to really go through the chairman's discussion draft that was introduced a couple of weeks ago, but in it, they're calling for the elimination of Section 1031, the like-kind exchanges. Have you had a chance to look at that and what the impact might be on in the agricultural section if we eliminated like-kind exchanges?
We're reviewing the whole proposal now and trying to get the sort of the big picture of what it means for agriculture and all the trade-offs that are there. I will tell you that our policy supports maintaining the 1031 exchanges. Those have been very useful for farmers and ranchers as they've gone about, you know, planning for the future, as they've gone about trying to expand their operations, and plus important for those who, you know, may want to move on and do something else, but, you know, want to try to manage the tax consequences of selling their land.
Yeah, well, I'd like to stay in touch with you and get some more feedback on what the impact might be, especially in the agricultural field. Mr. Redpath, appreciate your testimony, too, as far as the impact on S-Corps and the 5-year big holding period, something that Mr. Reichert and I have been working on with our S-Corp modernization bill. You've also indicated in your testimony you think that we need to expand the qualifying beneficiaries to include non-resident alien individuals as well. Could you explain why you think that's necessary?
Yes, thank you. The provision relating to the non-resident alien individuals deals with who can be permissible beneficiaries of electing small business trusts, which are eligible S-corporation shareholders. And it does two things. One, it puts S-corporations at par or closer to par with LLCs, their competing flow-through model, where LLCs are not restricted to the types and number of owners and the types of ownership. And this would allow S corporations to attract non-resident alien foreign owners through trusts only. In that provision, the trust actually pays the tax, and it pays the tax at the highest individual rate. So some of the positions are, who cares who the beneficiaries are? The trust is actually the taxpayer. The second and more important provision that I run into with regards to this provision is family business. More and more of our family businesses are resulting with non-resident alien family members who, without this provision, can't enjoy the benefits of family ownership of the family S corporation.
One other thing, Mr. Redpath, the 5-year big holding period and the impact on the charitable deduction provisions. Can you explain in a little bit more detail what impact that has?
Yes. I'll just give you an example. Let's just assume that a S corporation has appreciated property that it wants to donate to a charity, whether it's appreciated securities or land or a building, and they want to donate it to a charity. When they donate to that charity, they get a deduction for the fair market value of the property, just like anyone else, like an LLC or a C corporation or an individual. But they're required to reduce the basis in the stock that they own by that full fair market value. All other taxpayers get to reduce the basis by the basis of the property, which is substantially less than that. And so it results ultimately in not being able to deduct the full fair market value of the property.
All right, thank you.
Great, thank you.
Expired. I'm going to go 2-1 now. Mr. Reichert.
Thank you, Mr. Chairman. I want to add my thanks to you, too, for pushing forward with tax reform over these last 3+ years, and in fact, thanks to the entire committee, because this has been a bipartisan effort, over 40 hearings and meetings after meetings after meetings after meetings on tax reform. And so it's been a little bit in contrast to some of the other major bills that were passed in previous years, but this is an effort to reform the tax code. And the people on this committee know how hard that is. You certainly know how hard that is. Since 1986, we've been, hoping for this. People in this audience know, and I think the people around the United States understand how critical this is and how difficult this is. But the whole goal here is to create a tax reform bill that energizes business and, as Mr. Brady says, creates jobs. And that we don't work for the IRS any longer, but the tax code works for us, right? That's the goal. So there's a couple of things that I want to touch on, Ms. Zelisko, both in your oral and written testimony. First, the need for the permanence in the R&D credit from the U.S. for the U.S. to be competitive on the international level. And second, your concerns that eliminating supplies and computer software from the credit might have unintended consequences. On your first point, in Washington State, we don't have to look too far to see what other countries are doing to attract R&D. You may already know this. In Canada, not only have they reduced their federal corporate income tax rate to 15%, they have now a permanent 15% credit on research and development activities that applies to all expenditures and special accelerated depreciation rules that apply to so-called research assets. And on top of this, the various provinces and territories have added their own research tax incentives. For example, in British Columbia, right above the state of Washington, there is now a 10% credit for all companies on top of the federal incentive. On your second point, the unintended consequences of removing software and supplies from the credit, we've heard a couple of things. That no other country in the world specifically denies R&D credit eligibility for all software costs, and secondly, for manufacturer supplies such as test models can be an integral part of conducting scientific research. Could you please comment on both the importance of the permanence in the R&D credit to stay competitive on an international level and the potential unintended consequences for removing expenditures on software and supplies for the tax credit?
Yes, with regard to the United States has the opportunity to lead once again in this area. We did in 1981. But that recent OECD study ranks us now 22nd as far as the incentivization that the R&D credit provides here in the U.S. when it is in play. So I think, therefore, making it permanent is going to really accelerate and innovate and provide the incentive for businesses to plan, to be able to decide that we're going to be able to do that extra project as a result because we know that the cash flow is going to be there and it's not going to be on again, off again. So I think with regard to that, ranking number 1 in 1981 and now 22nd now, I think obviously says something that we need to basically take notice and lead as opposed to trying to catch up. So in that regard, with regard to the amount of items that should be allowed as far as qualified research expenditures, having supplies and software being part of the equation, which it was until the proposal here that we have before us, that I think is important. Supplies are critical as far as when you're doing research and development. Obviously, wages are the majority, as evidenced by the research and development credit. 70% of all expenditures relate to wages. But that means the 30% relates to supplies, not an insignificant amount. So I think if we want to be competitive, as opposed to regressing and taking a step back, I think retaining the supplies as a deductible, as a qualified research expense for the R&D credit is so important, along with software. Software is critical. Look at the developments of the companies that we've had here in the United States where software development we lead that in that forefront. I think we want to retain that.
Thank you. You bet.
Gentleman's time has expired. Mr. Bustani is recognized for 5 minutes.
Thank you, Mr. Chairman. I'm very pleased we're having this hearing today and happy that we're focusing on a bipartisan tax provision that I have long championed, and that is making the CFC look-through permanent. You can argue that a lot's changed since 1962 when a lot of these international provisions were written. And I think, Mr. Odens, you pointed out that Subpart F is antiquated because it sort of assumes that business is done country by country, on a country-by-country basis, and doesn't take into account the global nature of business today, the type of environment that U.S.-owned businesses are trying to compete in. These are companies going up against, these are American companies that create value, they create American jobs, and they're going up against foreign competitors. And so you pointed out in your testimony a couple things. One, the concept of making this permanent so that there's certainty for these companies, our U.S. companies, to plan and make sound business decisions. And you also talked a lot about the competitiveness of American companies vis-a-vis our foreign competitors. But this provision's not well understood. And I think we heard from the other side just a little while ago some relative misunderstanding about how this works in this 21st century economy and why it's necessary for U.S. companies. CFC look-through allows payments of dividends, interest, rents, or royalties in the normal course of active business operations between U.S.-owned foreign subsidiaries so that they can deploy capital without an immediate tax burden in their normal business operations. And it does not apply to passive, highly mobile income. It's an important distinction. But I want to give you an opportunity to expound further on this. Some have voiced concerns that the CFC look-through rule allows U.S. companies to avoid taxes on their foreign income. Well, if the rule only applies to active foreign income that otherwise is not subject to current U.S. income tax, isn't this really just about foreign taxes and not U.S. taxes? Is it really, at the end of the day, Congress's responsibility to force American companies to pay higher taxes to other countries?
Congressman, I think you correctly pointed out that in order to use the provision, it requires the payment out of active income. And so, the issue really is whether the U.S. should have a current inclusion of that income, or the taxpayer should get deferral for redeploying the capital to another location outside of the United States. So that's the issue. I look at it not as a provision designed to enable stripping from one country to another, but rather for flexible utility of cash. If you look at U.S. multinationals, U.S. multinationals are limited in how they can conduct operations without CFC look-through. They have to separate jurisdiction by jurisdiction or country by country. And when you compare, when you look at the EU, for example, the European Union is one zone, but yet U.S. rules require U.S. corporations to treat each country separately and distinct, which is certainly not how European competitors or other competitors look at the EU.
All right, thank you. I know when Congress enacted the provision in 2006, it wisely recognized that it would really create a level playing field for U.S. companies. But talk a little bit more about the competitiveness in the time I've got remaining. U.S. companies trying to operate in a 21st century global economy, a very competitive global economy. Give us some more background from that perspective.
Sure. On the competitiveness piece, look, cost of capital can be expensive, and obviously if a company can move funds from one jurisdiction to another by a dividend, as opposed to having to borrow from a third party, the cost of capital is lower, and it can be more efficiently deployed to a market where there might be a new opportunity. For example, an effort to expand in one country in the European Union that was untapped. It allows a U.S. company to deploy that capital in that place and open a new facility or sell into that marketplace and compete at the same cost of with the same cost of capital as a foreign competitor.
And this supports American jobs, right?
Yes, it does.
Thank you. That's all I have.
Thank you. Mr. Pascrell.
Mr. Chairman, thanks for bringing us together. I think this is a very important hearing. And as we've heard today, companies want certainty. And individuals rely on you and rely on that certainty. There are many extenders not on the agenda. It's about 50 of them. I hope they'll get a fair hearing as you're getting a fair hearing today. We can address the new markets tax credit, the mass transit tax benefit, the work opportunity tax credit, which has bipartisan support, and various other provisions. I support the goal of coming up with a permanent solution to the tax extenders. Like many other things here in Congress, this issue comes up every year or two, and instead of finding a way to solve it once and for all, we kick it down the street. The sustainable growth rate is a perfect example of SGR. If you debate what we debated it last week and passed it concerning our doctors. We had the momentum. We had the lowest score to repeal the formula in years, but we didn't have an agreement on how to pay for it. But we're trying. And that is the crux of the issue with extenders. We need permanence in our tax code, but we cannot sacrifice the progress we have made bringing down our deficits, which have come down at the fastest rate since World War II. Now, that's either true or false, what I'm just said. Simply not fair to put these provisions, which disproportionately benefit business, on the credit card. To do so would be incredibly hypocritical, especially since our Speaker has ruled out a vote on the fully paid-for extension of the unemployment insurance. Tax cuts don't pay for themselves. We learned our lesson, I think, in 2001 and in 2003 when the Clinton surplus evaporated, paved the way for structural deficits we continue to see. So we're pleased with when the draft of the chairman's tax reform legislation used the current law baseline. That meant a big deal. Now, Mr. Hungerford, it's good to see you again. You spent a long time with the Congressional Research Service, and your astute analysis informed many debates in this committee and throughout Congress. One report of yours that I almost carry with me all the time, it sticks in my mind, Taxes in the Economy, an economic analysis of the top tax rates since 1945. I thought it was on target. I referred to this before in discussing tax issues. My friends on the other side of the aisle often claim that tax cuts at the top are the key to unleashing economic growth in this country. Could you please summarize what the research you conducted for the paper I just cited found regarding the correlation between the top marginal and capital tax rates and economic growth and income distribution?
Okay, well, to briefly summarize, I found no correlation.
Talk into the mic, please.
Okay. I found no correlation between changes in the top tax rates for capital gains and for ordinary income and for various measures of economic growth, per capita GDP growth, productivity growth, changes in savings and investment. And I think if there were something there, I would have found a correlation, and so I think it was very telling that I did not find a correlation. You just do not see any movement, these various variables moving together in the data. I did, however, find that as the top tax rates for ordinary income and capital gains have come down, income inequality has been going up, as measured by the share of total income going to the top 1% in the income distribution.
So we got to get beyond the first blush that would indicate that the more investment that comes from the top necessarily and the more tax breaks that the top 5% receive is going to automatically transfer into economic growth, jobs in the economy. You made that study from 1945 on. Why are we still relying on that myth that if we take care of the top, and I'm exaggerating it now, let me use hyperbole, I have that option right now. If we continue to do things for the top, that everybody else is going to be wonderful. Why are we still using that myth?
I wish I knew.
All right, time has expired.
Thank you, Mr. Chairman.
Thank you. We'll go to Mr. Smith.
Thank you, Mr. Chairman, and thank you to our panelists here today for sharing your insight and expertise. I think you've all touched on the fact that a permanent tax code is a somewhat simpler tax code, certainly eliminates one of those unpredictable provisions of the tax code. We know that the marketplace is volatile, impacts the economy in various ways. And Mr. Stallman, I know that agriculture certainly sees the volatility of the marketplace and tries to manage that. We hope we don't have volatile tax policy as well. Can you, especially in the light of the fact that agriculture, I think, has done very well with producing more, using less water, less resources, less land. I think there's a great story to tell there. But can you perhaps illustrate kind of the added risk to agriculture given uncertain tax policy?
Well, it impedes, the progress of the industry with uncertain tax policy. I mean, the risk is that without knowing what the tax policy is, without being able to make business decisions where we have some certainty for the future, then, that inhibits us from creating as a productive and efficient platform as the industry needs for the future. You mentioned some of the progress we've made. We've made tremendous progress on so many fronts in productivity, but also in use of resources. But a great deal of that has to do with acquiring the technology, the equipment, the tools to be able to do that. And those are getting more expensive by the year. And so particularly in things like our expensing policy with Section 179, that directly relates into our ability to make those decisions to maintain an ever-improving production platform for U.S. agriculture. And without that, we don't have that certainty and will be inhibited in making those decisions.
Okay. More specifically, perhaps, could you elaborate in terms of Schedule F filing, what that means to your members, and especially how that would relate to permanent tax policy?
Well, as farmers and ranchers, we do file on a separate schedule, Schedule F, as you referenced. The big issue there for us, I think, is cash accounting versus accrual accounting. In terms of being able to file on a Schedule F and being able to, frankly, manage our finances and our incomes and our tax expenditures to a certain extent using cash accounting as opposed to accrual accounting. In the long run, all it does is allow us to sort of remove the ups and downs that are inherent in the volatility that we experience, both in terms of the marketplace and in terms of the weather. So, for some years we'll have a very large income. For other years we will have much less. But without some ability to sort of manage those swings from a tax and economic standpoint, once again, it makes it more difficult for us to do our business as farmers and ranchers.
Okay. Well, thank you again to our panelists, and thank you, Mr. Chairman. I yield back.
Thank you. Mr. Paulson.
Thank you, Mr. Chairman. And Mr. Chairman, before I begin my questions today, I just want to take a moment to thank you and your attention on this issue for permanency in the tax code, but also the attention you've given in part of your tax draft to the medical device tax repeal. And there aren't many such as yourself that are paying such close attention to a very unjustifiable tax that is killing good domestic jobs and manufacturing jobs and cutting research and development and denying patients access to those innovative therapies that are so critical, I think, to our country. But let me ask you this. This is a very helpful exercise. Some of our witnesses, I appreciate you being here today. And as we focus on a pro-growth tax code, and this has been, I think, one of the biggest criticisms of Congress, and you've really laid out individually on various different aspects of the code. Short-term thinking, short-term fixes, actually, versus long-term thinking, right? What should be the direction to go? And you can apply that to transportation, healthcare, and certainly to tax policy as we try to get the economy going. And I hear constantly from companies in particular that say, look, if you have a retroactive tax provision, if you extend something for 6 months, if you extend it for a year, you're not going to have any confidence, certainty, or predictability of how we're going to invest capital in our economy. And that's why this is a very helpful exercise. Mr. Redpath, I want to ask you a question, though. You testified earlier, in particular about your comments supporting the extension of this 5-year built-in gains holding period. And I'm pleased also the chairman recognized that this is a very important provision, and it's included as this big tax relief provision in the tax reform discussion draft. And this might seem like a subject that's very trivial, and accountants such as yourself are aware of it, that might not have an actual impact on our economy at a grand scale, but IRS statistics do suggest that thousands of U.S. businesses are actually sitting on top of appreciated assets that could be put to better use. And you give a couple of examples of that. In an economy that's short of capital now, it just seems to make sense to me that we allow businesses to increased access to their own capital, their own assets. You mentioned in your testimony the lockup or lockdown of that capital that's built into the built-in gain taxes that result in. How difficult has that issue been for S Corporation clients that you work with? Is it a pretty...
Yeah, it's been difficult. Let me
real
talk
issue?
about that. Before, you know, I am a tax accountant. I thought it'd be my responsibility to remind all of you that your returns or extensions are due next Tuesday. Yeah, we have clients that look at how they can raise capital. When their capital is locked up as a result of this provision, what can they do? One thing you got to remember is S corporations cannot get money from the public markets. Public companies cannot be S corporations. So what are their alternatives? One is they can go borrow money. Most small businesses are not interested in borrowing large chunks of money to raise capital. They could consider selling part of their shares to venture capitalists or private equity firms who have probably competing interests and conflicting interests with regards to ownership. Generally, they're looking at flipping a company. Most of these companies that I'm talking about are closely held family businesses. And you know how they generate capital? The old-fashioned way. They earn it. They make money, they pay their tax, and they retain it. And what causes them to slow that down are a few things. Tax rates. Tax rates matter to flow-through entities. In Minnesota right now, many flow-through entities are paying in excess of 52% combined federal and state taxes. That's after paying sales tax, property tax, excise tax, payroll taxes, and the built-in gains tax. They're sitting on capital, like we talked about, that they can't generate the old-fashioned way by earning it and converting it to the appropriate assets to increase earnings. Truly, that's what small businesses that I work with, that's their primary way of generating capital through earnings.
So actually a little esoteric provision of the tax code that is dealt with from a permanency perspective can actually drive a lot of economic growth, can be a pro-growth initiative, you're saying, and there are other avenues that some of these S corporations are closely held family businesses might have to access capital, but they're not easy to access.
They're not easy to access, and they don't serve the purpose of the entity, the business, and the stakeholders of the business.
Thank you, Mr. Chairman.
Thank you. Mr. Davis.
Thank you very much, Mr. Chairman. I want to thank you for the hearing, and I want to thank all of our witnesses for coming, especially would I like to welcome Ms. Zelisko from Lake Forest, Illinois, just a few miles from my district, and from Chicago. Mr. Chairman, while I'm pleased that we are considering these 7 areas, I would look forward also to looking at transit, parking, and things like low-income tax credit, tuition credits, new market tax initiatives, work opportunity tax credits. And I have 2 documents I'd like to submit for the record from the Regional Transit Authority and from the National Grocers Association. I ask unanimous consent.
Without objection.
Thank you very much, Mr. Chairman. Ms. Zelisko, let me ask you, the research tax credit has been vital to ensuring that the U.S. is in the best place in the world for companies to conduct research and business. I know that you work for one of these companies and work with companies. Could you tell us how your company has made use of this area?
The research and development credit.
Yes.
Yes, it's very important to the company. I mean, it's an important element of determining what projects we're going to be looking at because it determines our cash flow. We obviously generate cash flow from just of our earnings of the company, but that cash flow is increased by the research and development credit because it does reduce our tax liability, and that money is then redeployed into determining and investing in new products for the consumer, meeting environmental requirements about emissions. So these are all important items that therefore generate jobs. And with the successful product that I mentioned of about 150 horsepower 4-stroke marine engine, so successful we had to expand our plant. Therefore, that means bricks and mortar that were added and created jobs in the construction business. Also create additional jobs for engineers that we have in Fond du Lac, Wisconsin. So This, and plus in our marine business with regard to the different items that I listed in my written testimony, all the different products and innovations that we've made, given the competitive nature of the business in which we do business.
Thank you very much. Mr. Hungerford, you discussed in your testimony the reasons why it is important to be fiscally responsible when addressing tax extenders. What would be the likely effect on the GDP and economic growth if the 7 provisions discussed today are made permanent without paying for them?
Well, what just comparing to the baseline, I would expect that GDP growth going out would be smaller or would be lower. If interest rates do go up, we'll end up seeing less investment, which will have an impact on GDP growth and on jobs and employment possibilities.
Thank you. Mr. Stallman, would you briefly tell us how Section 179 expensing rules are used in the farming industry?
Let me just illustrate that with an example. For instance, if I need to go out and buy the tractor I referenced, let's just say that it costs $150,000 to $200,000. Let's just say $200,000. Without Section 179 expensing, I would be limited to taking a deduction. Let's assume it's used, by the way, and not new. I would be limited to taking a deduction of $25,000 and then depreciating that over multiple years. That affects my cash flow. And so, therefore, I would have to not have the benefit of postponing some tax payments, if you will, by accelerating the depreciation and then having to take those expenses in future years. So the net effect roughly would be the same over time. But the point is that extra cash flow that would be allowed by being able to accelerate the deduction using Section 179 expensing would allow me to more easily make the investment.
And so it becomes very helpful in making sure that you would be able to acquire and make use of that John Deere that you're
absolutely, except mine is Case IH, Congressman.
All right. Thank you. Mr. Reed.
Thank you, Mr. Chairman. Just wanted to explore, Mr. Odence, if I could, as I co-chair the U.S. Manufacturing Caucus, also down here in Washington, D.C., and focusing on AFE, the active financing exception. Can you give a little detailed, more analysis as to how U.S. manufacturers can become more competitive by the AFE exception and how that impacts U.S. manufacturers' ability on a competitive basis internationally?
Sure. So a U.S. manufacturer, when it decides to export goods manufactured in the United States abroad, can establish under AFE a financing or a leasing subsidiary in a foreign country, and that leasing subsidiary or financing subsidiary can offer financing on expensive widgets like earth-moving equipment or very expensive other equipment, airplanes, etc. And what AFE allows that company to do is to compete on a financing perspective, provide similar terms as foreign competitors. So let's say a widget maker based in the United States sells its product in the European Union. A similar company making a similar widget based abroad is going to offer financing terms that are reflected in that market. And what AFE does is it allows a U.S. manufacturer to provide the financing terms that are equivalent that can be provided by other foreign financial institutions.
So do you have any analysis or any data that you could support if AFE was not extended on a permanent basis, how of a competitive disadvantage that would put U.S. manufacturers?
I don't have macro data. I can see from clients that their terms of leasing or loans may be higher than competitors, which puts U.S. manufactured goods at a competitive disadvantage.
Does anyone else on the panel have any data or impacts from any of their clients or anything? Okay. I also wanted to explore a little bit on the look-through issue, and how does that, the temporary nature of the rule, obviously being a country lawyer from Western New York, small business owner, one of the biggest things, and we've already heard it numerous times here today, is the lack of certainty really impacts the ability to plan. And I always had a business plan. I had a 5-year plan, 10-year plan, and I did that with 30 employees that worked in our businesses that we created. If you do not have that certainty, tell me from the look-through perspective, what kind of decisions, nuts and bolts, what kind of decisions are put off, which ones are prevented, or which ones are not taken as a result of having that lack of certainty?
Sure. For example, clients that do not have look-through have to price in the cost of capital and whether and where to expand foreign operations. And obviously, if a company has to take loans from banks, that cost of capital is more expensive than rather than deploying its own internal capital from one jurisdiction to another. So when a company computes or determines whether and where to expand its operations, it takes into account the after-tax profit. It accounts for tax and then is interested in making an after-tax profit. And so not having CFC look-through adds to that cost of capital and makes it more challenging to expand foreign operations.
Does anyone have any anecdotal cases that you could share with the committee as to actual jobs and expansion here on American soil that was caused because of this lack of certainty?
But obviously, it's also important to have permanence or at least more than a 1-year extension, because business decisions are not made on a 1-year basis. They're long-term. Businesses want to derive profits over the long term and make permanent decisions. And so a temporary provision makes it difficult to plan for the long term.
Well, and that's a great point, because we're talking about large capital investments here. We're not talking about 1 year. What would be the size of the typical investment we're talking about?
Well, for example, building a plant is a rather expensive endeavor. It requires also hiring the labor force to fill that plant. So you're looking at multiple billion-dollar investments in many instances.
And if you don't have that certainty to make that decision on that multi-billion-dollar decision, that's what you're referring to. That's the real, where the rubber meets the road, so to speak.
Exactly.
Yeah. With that, Chairman, I just yield back.
Thank you. Mr. Young.
Well, thank you, Mr. Chairman. Thank you to all of our panelists for testifying here today. I really appreciate all we've learned, and I want to thank the chairman in particular for making permanent the CFC look-through provisions in the draft and holding a hearing so that we might discuss that provision in particular a bit further. I have concerns about our intellectual property intensive related firms and also our continued investment in R&D, which as we all know is essential in this modern economy we live in. So we'll look forward to working not only with fellow members of the Ways and Means Committee on that, but other stakeholders as we try and improve the international sections of the draft. That's a sort of a lead-in to R&D. Ms. Zalesko, you indicated something that many of us have read, and I think many of my constituents intuitively understand, which is that the U.S. doesn't have a monopoly anymore on global R&D. In fact, you cite a figure, since 2001, the share of the world's R&D performed in the U.S. has decreased from 37% to 30%, and to the extent we can arrest that trend line, that would be a good thing. I think we'd all agree. Can you talk about what role tax policy plays with respect to that dynamic?
The companies look at the world on a global basis. We're no longer international, we're global businesses. So therefore, looking to where you're going to deploy your R&D is important, and therefore the impact of tax policy plays a part and is a factor. So this is an opportunity for the U.S. to lead as far as where do we want this technology? Do we want it here? Do we want it outside the United States? I think we want it here. It provides jobs, it provides innovation, technology, and from that technology spurs other technologies. So I think good tax policy is going to look at a broad-based, simplified, something that's administrable. I think the alternative simplified credit provides that. I would encourage that it be increased to 20%, according to, I think, as far as being truly an incentive, and also the broad base on the qualified research expenditures that would qualify for the credit, I think is important. Because when you look around the world, they're not reducing the expenditures. They're increasing them, or they're increasing the amount of the credit or the multiplican on the deductibility of the particular expenditure. So I would think good policy would be broad-based with regard to what would qualify for qualified research expenditures and the actual amount of the incentive.
So it needs to be, in short, made more inclusive, more generous from your vantage point, but you certainly support the permanency of the provision.
Absolutely. I mean, that's critical. I mean, I think that's sort of like a baseline, that you need to have permanency. I mean, when you're making business decisions, you're not, especially in the R&D area, you're looking out, like I mentioned, 4 to 5 years. So you need certainty with regard to that it's going to be there during the entire process.
Thank you. I represent a district in south central Indiana, southern Indiana, and it's very diverse economically. We have a fair amount of small, medium-sized manufacturing, certainly IP-rich firms, both in the district and around the district, and also agriculture plays a significant part in our economy. So, Mr. Stallman, pivoting to the ag sector, you've described the Farm Bureau's perspective, if I could get that out, related to the impact of the $250,000 Section 179 threshold versus a $500,000 threshold. And why is the higher level so important to your members? It pertains to just the ability to buy more farm equipment. You need a more generous level to incentivize them to do so. That's correct?
Yeah, the difference, and I tried to convey that in my oral statement, the difference between the $500,000 and the $250,000 is primarily related to what we're seeing in the cost of the equipment and the capital expenditures we have to make in agriculture. It's continuing to increase very rapidly, and frankly, while $250,000 10 years ago used to buy you a lot of equipment, not so much anymore. And so that's why the $500,000 is very important.
So the inflation of those costs is certainly something we need to take into account, balance that against a lower 25% rate, and I guess every individual farm is going to have to come up, individual operation, with the sort of net impact. But does the Farm Bureau have a policy articulated with respect to that trade-off?
No, we don't. We are looking at the whole draft proposal to see where those trade-offs are. It would vary tremendously across individual operations. As a general rule, that expensing provision, I think, would probably have more positive impact on farms and ranches in the way they make the decision, even though it's not, tax avoidance because you're just postponing paying the taxes, than perhaps lower rates. And once again, it would depend on the rates.
Thank you.
Thank you. Mr. McDermott.
Thank you, Mr. Chairman. Ms. Zalesko and Mr. Young and Mr. Reed have sort of laid out sort of what I was thinking about, which is that I was a Ways and Means chairman a long time ago in the state legislature, where a businessman told me, I don't care what rate you charge me, just tell me what it is and how long it's going to last so I can figure out how to amortize it. And that's really what you're saying about the planning. And the chairman has one other power, and that is to set the agenda. So today we're discussing 7 tax provisions. There's a whole lot of them that have not been discussed. I think some of the ones that are up here are sound. I think the research and development tax credit's good policy. Even if the draft probably needs a little revision, specifically in the areas of software, and I think Mr. Young already mentioned that. Some of us who come from areas like I do, where research is a big issue in software, we'd like a little tweak or two on that whole provision. But the real question is about the ones that are not going on, and why aren't we debating them? Residents in states with an income tax can deduct their income taxes. Residents in states that have a sales tax in lieu of an income tax cannot deduct their sales taxes if we don't pass the extender in this bill. So you have to ask yourself what the impact of that's going to be. And I would suggest that in Washington State, Florida, South Dakota, Wyoming, Alaska, Texas, the Republicans are raising taxes on consumers. Those of us who are claimants on a sales tax in the state of Washington will pay $2,000 more in taxes next year if we don't have that extender. And I have to ask myself what kind of impact that would have. And I think, Mr. Hungerford, maybe you have an idea. If we raise taxes on people at the consumer level by not extending the sales tax exemption, what's the impact of that?
Well, in the short run, it does take money out of people's pockets that they would ordinarily spend. I guess the question is who actually takes the deduction for state and local sales taxes. How much you save and how much you spend of your income depends on where you are in the income distribution. So it's, without actually looking at the data, it'd be hard to say what would be the actual economic impact, but to the extent that money that would have, the money that ends up going to the government, if it had been spent, it would have at least provide some short-term stimulus to the economy.
You think that this is free money we're talking about here today. We don't have to pay for this. So would it be better to give money to consumers to spend in the economy than to give money to companies to do research? How do you make that decision?
It's a tough decision to make.
That's the reason why we're not having a discussion about the whole broad range of extenders. We only got these 7 over here as though they were selected by somebody to be exactly what we ought to be doing. I also have one that I have some question about what the point of it is. Why, under the chairman's plan, what makes sense to make charitable deductions only if the contribution exceeds 2% of the individual's adjusted gross income? It sounds like we're putting a floor in there, and the CBO said imposing a floor would lower contributions. So why do we want to lower contributions by putting a floor in? What would be the advantage to the society to, at a time when we're looking for people to give money to whatever? How is that better for the society?
Well, actually, I haven't looked at CBO's study on how much it would lower contributions. On the margin, it would not have any effect, just because the people who are on the margin would be well above that 2% of AGI threshold, and their incentives to contribute to charitable organizations would not. And then, of course, it would not affect people who do not itemize, that many people make charitable contributions and aren't allowed to take a deduction because they do not itemize. Then there is this group in there, and I don't know to what extent that they would be affected. I mean, I would expect that there'd be some effect. I'm just not sure how large it would be.
All right, thank you.
I guess
I would just say,
Chairman.
I would just say that this is the first in a series of hearings. These items were chosen because they are in the discussion draft, and so we wanted to start with these. But as you know, the president's budget has proposed a ceiling on charitable contributions, which in our hearings, the charitable community has very much opposed. But obviously, in order to lower rates as we do in the draft, there are trade-offs. But as you know, the analysis is that charitable contributions will actually increase by $2 billion a year because of a lot of the moving pieces in the draft, not just this provision looked at in isolation.
Would it be your intention that when we had a markup, we would have the ability to offer other amendments than the 7 that are in your bill?
We're going to have hearings on a series of, and I'm not exactly sure of the procedure that we're going to take in terms of a markup yet, but there will be probably more than one markup going forward.
More than one markup?
Probably more than one markup going forward.
So
but I haven't fully decided that yet.
Okay.
Yeah.
All right. I just want to reserve the right to offer an amendment at some point on the sales tax in Washington State and in Texas and Florida.
I understand your interest there. All right, we're now at Mr. Kelly.
Thank you, Chairman. Thank you for having this hearing. Thank you all for being here. I come from the private sector, so when we talk about taxes and what we're trying to do, pro-growth tax reform could probably not be more important than anything else we do in this country other than also regulation reform. I'm more interested in people that come from the private sector because they're the ones that provide all the revenue that's needed to run all these wonderful, wonderful programs we have. Mr. Stallman, you're in agriculture. I would just say that right now, you made a statement. The ability to have some type of predictability or certainty is absolutely critical to any of us in the private sector. And there's an old saying out there, if you don't know where you're going, any road will get you there. Well, at this point right now, what the chairman has offered is a road, a path to prosperity, part of it being this tax reform. And I think sometimes people get mixed up, and I hear all these different talks about this section, that section, every little section, and people, they'll sit down and they'll debate that for hours. But at the end of the day, the question becomes, are we helping to grow this economy? Are we making it tougher for people who actually supply the revenue to get there? And we're making it so hard on the private sector to get there and then holding them accountable for not supplying enough revenue. The last time I looked, the only people paying taxes are working folks and companies that are profitable. This tax reform is absolutely critical right now. Mr. Stallman, you started to talk about making capital investments. There's no way in the private sector, if you don't know the certainty of where this tax code is going to be, that you can make a long-range commitment to do something. You just can't do it. So each of you, I'd like you to just to weigh in a little bit because it's really important, not so much for us here in Congress, but for people back home to understand, they actually understand what it's like. They've actually gone out there and got up every morning and swung their feet out over the side of the bed and went to perform some type of an activity that will support their families, support their communities, support their region and their country. This thing has gotten so far out of control. And you all know this. The cost of tax preparation, not the tax bill, preparation, $168 billion in about 7 billion hours. My goodness. Could that time have been spent a little better, and could that money have been reinvested? Because I'm looking at capital investments. You have to have some reason to do that, and we're truly engaged right now in a global economy, right? So we just don't compete. Illinois doesn't just compete with Ohio.
Because I'm doing
Pennsylvania doesn't compete with New York. We compete with everybody in the world.
And I just was
the last time I looked, we have the highest taxes in the world. Is that right? So any of you in the private sector, please tell me, part of your economic model is the total cost of everything that you do, which includes tax obligations. Is there anything about what we're trying to get to that doesn't make sense? And the chairman just said today, we're only talking about 70 extenders. What could we do? What could we do to give all of you in the private sector a little look into the future that says, you know what, they know where they're going, and they're going to make it easier for us to get there. I just hate like heck the fact that we seem to be adversaries of yours and not advocates, and then we turn around and hold you responsible for not supplying the revenue that we think is necessary for all these wonderful programs. So any of you that want to weigh in on it, just America needs to hear that we get it. We understand their plight. Ms. Liska, any of you.
Well, I'd like to offer that I don't want the U.S. to be 22nd in the world as far as research and development incentives. I want us to be number one. And a way to get there is obviously making our credit permanent, broadening what is included in those qualified research expenditures, including what we currently have of supplies and software expenditures, along with the wages that are from the engineers and the scientific individuals that we employ to provide that improved technology. When you're an innovator, lots of things are correlative and spur off from that. And I think if the policy is set that we have the certainty, companies will become, once again, a source of tremendous innovation here in this country.
Well, U.S. agriculture is the #1 exporter in the world. We have built a very strong, productive, efficient, competitive industry in this country, and we want to keep it. And I think that's the crux of the issue. What do we need to keep it? Well, we need some certainty around tax policy. There's a sense, I believe, in the countryside that farmers wake up one day in the spring and say, oh, golly gee, I have to go out and plant something. Mm-hmm. The reality is they're making plans 3, 5, and 10 years in advance in terms of their capital expenditures, how they manage the infrastructure of their farm and ranch, and how they're going to be even more productive in the future. And having the uncertainty of uncertain tax policy laid over that makes that task very difficult to plan for the future and continue to be competitive and efficient.
All right, thank you. Mr. Marchant.
Thank you, Mr. Chairman. And thanks for bringing forth what are the most important extenders as far as my district is concerned. The modified research credit made permanent would have a very significant impact in my district. I have a district that has the headquarters of Exxon, Fluor, Kimberly-Clark, AT&T, and Verizon. So all of those companies rely very heavily on the research and development. But really the impact of these extenders that we're talking about today and their correlation to the long-term tax reform really hits home in those thousands of businesses that surround these big companies. And my district surrounds the DFW airport, so I literally have thousands of businesses that rely very heavily on Code Section 179. And as we speak, there are people sitting in their offices with their accountants because this is the week they're talking to them. And they're talking to them about, can I buy a new truck? Should I buy a new machine? How about a new forklift? How is that going to affect me? And they're talking at this moment about, well, we don't know whether Section 179 of the code is going to be extended. So if you buy the truck or you buy the forklift or you expand your business at this point and they don't extend it, here's going to be the tax treatment. Here's the implication it's going to have on your business. But if they do, this is what's going to happen. So I'm, Mr. Hungerford, what kind of impact would that have, not on future economies, but just the recovery that we're experiencing now, the slowness of our recovery? What kind of impact will that begin to have in the coming months on business, their expansion, the auto industry, the tractor industry, et cetera?
Well, my guess is not a great deal. That I've always found that temporary tax provisions that are designed to stimulate the economy rarely stimulate the economy.
So you would consider this just to be a temporary tax stimulation and should not be included as part of the permanent
Section
code?
179 expensing?
Mm-hmm.
I mean, the thing is, if you let it expire now, or actually it's already expired and fail to extend it, I don't think it will have a large impact on the economy.
Is there any disagreement among the panelists on that?
Well, I don't have a study to back it up. All I know is the behavior of farmers and ranchers. I will tell you that with the certainty, with Section 179, they will be more inclined to accelerate their capital acquisitions than what they would otherwise, and be more capable of doing it because of the cash flow benefits that occur, up front. Long term, once again, they're going to be, having less expense in the future to deduct. But that behavior will create more economic activity. I don't know about what the impact would be.
Mr. Redpath?
Yes, my experience is, my clients are interested in planning. And if the law is permanent, it's much easier to plan. And lots of my clients right now are holding off on making acquisitions because they don't know what the rules are. And I believe that's going to have a snowball effect on investment and on the other larger companies around that are impacted by these small companies working with them.
Thank you, Mr. Chairman. Yield back.
Thank you. Mr. Griffin.
Thank you, Mr.
Last
Chairman.
but not least.
Thank you, Mr. Chairman. I know that a lot of the questions that I might have wanted to ask have been covered, so I just want to make a few comments. I've heard the uncertainty argument ever since I first ran for Congress, and I totally agree with it. But I hear it regarding the tax code. I'll be real honest with you. From a lot of people, I hear it regarding this administration. They're waiting till this administration is gone before they invest because they believe it's an anti-business, anti-growth administration. But let me say this. I want to applaud the chairman for tackling tax reform. I know that not everybody likes 100% of it. You're never going to find that in Congress. But I think it is a historic moment to start that conversation. We do need to get away, for the sake of certainty, we need to get away from a lot of the patches, whether it be in SGR on Medicare or whether it be on our tax code or whatever else. We need that certainty that you're talking about, and I believe that our growth is tied to fixing the tax code in large part. I did my own taxes this past weekend, finished them. They're relatively simple in terms of complexity, but it was ridiculous how much time it took me. I'm embarrassed for the country, to be frank, at the complicated nature of our tax code. And I can see with me, an individual, how complicated it is, and it pains me to think of what you guys have to go through. So I appreciate you being here. And until we do get it fixed, I also applaud the chairman for taking the steps necessary to address these issues. I'm a firm believer in R&D. I will tell you, I don't just want to beat other countries. I want to beat them so badly that companies around the world say there is only one place in the world to do business, and that's the United States, and there are no other options. And I can tell you that's not the state of affairs right now. I think the tax code is part of it. Certainly, we need to encourage R&D. And I would just point out that I have a lot of agriculture, not only in my district, but throughout Arkansas. And the small business expensing is critically important to them and many others. So such is the burden of being last in line, that all the good questions are gone. But I want to just thank you for being here, and thank you for what you do. And I just want to say thank you to the chairman for putting these issues on the table and for starting the discussion. And you've seen it in your op-eds and papers. You're starting the discussion about what we can do, because the one thing we can agree on is the status quo is unacceptable, and we can do much, much better than we're doing. Thank you all for being here.
All right, thank you. Thank you all very much. Very much appreciate your testimony this morning. And with that, this hearing is adjourned.
Nice job. Nice end. Yeah. Nice wrap up.